How to trade in uncertain situations. Hello, welcome back to Mr. Suw Crypto, the hangout spot for crypto explorers who aren't just after profits, but also want to understand. In this episode, we'll discuss something extremely important, especially if you've been feeling like the market lately is making your head spin, your heart waver, and your portfolio turn red like a traffic light with a malfunctioning brake light. Yes, we'll be discussing how to trade in uncertain situations. Because let's be honest, lately the crypto market has been like an ex who disappears without a trace, sometimes giving hope, then suddenly losing direction. Prices rise a bit, and people start FOMOing. Then boom, they drop again due to war news, economic data, or anything that can flip market sentiment. Those who were confident opening long positions are now holding on to losses. Those who opened short positions ended up getting caught in a short squeeze. And amid all this chaos, many people are just getting more confused. What should they do? That's why this episode exists. Not to give predictions or buy-sell signals like a digital fortune teller, but to help you think more clearly, more calmly, and of course, more strategically. Because if you know how to handle uncertain situations, you can survive, and maybe even level up to become a more disciplined trader. We won't talk about complicated technical stuff like weird indicators, but we won't just give empty motivation either. We'll discuss mental and practical strategies you can apply right away, from focusing on more stable assets to ways to reduce risk so you don't run out of ammunition before the market recovers. Because here's the thing, bro and sis, in the crypto world, it's not the smartest who survive. It's the ones who are most prepared when the storm hits. And sometimes, the best strategy is to do nothing at all. So sit back, take a breath, and don't panic. In this episode, we'll have a relaxed yet insightful chat, and hopefully it can be a companion for your thinking, not just mindlessly clicking buy and sell buttons without direction. All right, let's dive into Chapter 1, because this is the first step you need to remember well in situations like this. Chapter 1. Focus on Bitcoin. Time to return to the most stable home. All right, everyone, imagine this. You're in the middle of a forest, thick fog, strange animal noises everywhere, GPS malfunctioning, no signal. In such a situation, you'd get lost if you tried to navigate on your own, right? Well, the current market conditions are exactly like that. The crypto market has been shrouded in fog lately, noise everywhere. From war news, inflation data, interest rates, to economic official statements that sometimes send the market on a roller coaster ride. Not to mention many altcoins suddenly surging 30% only to crash 50% overnight. And amid all this chaos, the only compass we can still rely on is Bitcoin. Yes, Bitcoin. Why Bitcoin? Because when everyone else is panicking and all the altcoins are spinning out of control, Bitcoin is like the sturdiest house in the storm. It's not just the first and largest asset in crypto, but also the most closely watched by institutions, the most liquid, and the most monitored globally. If we compare it to a person, Bitcoin isn't a drama queen who causes trouble every day. It's more like a calm, serious, and unflappable father figure who doesn't get caught up in petty FUD. And in a situation like this, what we need is emotional stability, not profit opportunities from unclear microcap coins. Trust me, many traders end up battered not because the market is bad, but because they're too busy chasing noise. Too many coins, too many signals, too much FOMO. What's the result? Overload, overtrading, overthinking, then losses. So the first sensible and proven safe strategy in this uncertain situation is focus solely on Bitcoin. This doesn't mean altcoins shouldn't be traded at all, but we must realize that Bitcoin is the primary barometer. If Bitcoin isn't healthy, don't expect altcoins to fly consistently. In fact, usually, if Bitcoin coughs, altcoins can immediately end up in the ER. By focusing solely on Bitcoin, we can take the time to truly think, not just react. We can learn from Bitcoin's dominance movements, its market volume, and how prices react to major news. And one thing you need to know, when the market is uncertain, large investors will return to the strongest asset. And that means Bitcoin. More than that, Bitcoin has a history. It once dropped by 80% and recovered. It was once dismissed, then adopted as an institutional reserve. Amid all the uncertainty, Bitcoin has a track record, a measurable history. Meanwhile, altcoins, many were created yesterday and could disappear tomorrow. So, if you feel the market is too chaotic, don't add to your stress by monitoring hundreds of coins. Just focus on one Bitcoin chart. Feel its rhythm. Understand its patterns. That's enough to survive, and sometimes, it can even be profitable if you're patient. And one bonus of focusing on Bitcoin, you won't fall into clickbait traps as easily. Because trust me, there's a lot of sensational content out there. This altcoin can go 10x. This coin will moon tonight. But the reality? 90% of those coins will just stress you out, not make you profit. Focusing on Bitcoin doesn't mean you have to hold forever or become a blind fanatic. But in the current situation, this is the most rational step. Because in the world of trading, surviving is more important than looking cool. What's cool doesn't necessarily make money. But what survives has a better chance of winning in the long run. All right, let's wrap up Chapter 1 and move on to Chapter 2. Only trade high-conviction plays. By the way, this is a very important part, especially for those of you who feel like you've been trying out trades too often just because you saw a coin rise on Twitter or FOMO from a WhatsApp group. Chapter 2. Only trade with high conviction. Stop trying random coins. This is not a lottery. Bro and sis, now I'll ask you honestly. How many times have you entered a trade just because someone said, "Hey, I think this is going to pump. Look at the chart." Or, "This coin is trending a lot on Twitter, just go for it." And in the end, yeah, you end up losing money. This is one of the biggest issues among traders, trading without conviction. And especially in today's volatile, unpredictable market conditions, one thing is crucial. Don't take positions randomly. Only take positions you're fully convinced of, backed by data. What exactly is a high-conviction play? A high-conviction play doesn't mean you have to be a fortune teller or psychic. It's more about you understand the coin's fundamentals. You know why its price is moving. You're aware of the relevant catalysts, news, events, narratives. And you have a plan if the trade fails, not just hoping for the best. So, it's not just because the chart is forming a W, or the RSI is oversold, or an influencer says, "Bullish, bro." If you don't know why the coin is moving or what the trigger is, and you still enter the trade, that's called gambling. And in an uncertain market, gambling isn't a strategy, it's slow suicide. Why is conviction so important right now? Because the market right now is like a stormy sea. Not all ships can survive. If you trade recklessly without conviction, you're like riding a cardboard raft. When the waves come, you'll be swept away, who knows where. But if you enter a position with conviction, it's like boarding a steel ship with a compass and a map. There's still risk, but you know where you're heading and when it's time to return to port. An example of a low-conviction trade is like this. Wow, this coin has risen 15% in an hour. Let's jump in, FOMO. People on Telegram say this is a good project. Let's just jump in. Wow, a big green candle. That's an entry signal. But there's no volume, no news, and the project is unclear. Meanwhile, a high-conviction trade looks like this. All right, this coin has a strong narrative this week, e.g., RWA, AI, LSD. There's a major event next week, upgrade, airdrop, Binance listing. Volume is rising, BTC dominance is stable, and the technicals align with my strategy. I understand the project and know the risk-reward ratio. That's what I call trading with well-founded conviction. Quality is more important than quantity. In a sideways, volatile, or unclear market like now, you don't have to enter positions frequently. What matters is the quality of your entry. Instead of entering 10 trades where 7 are just following the crowd, it's better to take 2 trades where you truly understand the reasoning behind them. And this is a mindset rarely found among new traders. Doing nothing is also a strategy. If you haven't found a setup that truly convinces you, just wait. Have a coffee. Look at the chart. Read the news. If the market gives a clear signal and you understand the reason behind it, then enter. High conviction also influences how you manage your trades. If you enter a position with conviction, you don't panic when the price fluctuates slightly. Don't rush to take small profits. Stay calm because you know this isn't just a guess. On the other hand, if you enter randomly, you panic at a 2% loss. You close the position at the slightest uptick because you're afraid it'll drop again. And in the end, you lose money, even though the market wasn't actually heading in the wrong direction. One warning: conviction isn't stubbornness. Conviction doesn't mean stubbornly holding onto a coin that's clearly broken down just because I'm sure it'll come back. No, conviction has a basis. If the data and market no longer support it, you must be ready to cut losses and move on. Don't get attached to a position. This is trading, not a Korean drama. In conclusion, when the market can no longer be read using ordinary logic, you need to step up your game. Reduce the number of trades. Improve the quality of your analysis. And only take a position if you truly understand and are confident in what you're doing. While others panic and chase random coins every hour, you can stay sane and survive because you're trading with conviction. All right, everyone, let's move on to Chapter 3, Reduce Position Size when Trading. Earlier, we discussed the importance of conviction. Now it's time to talk about something that's often overlooked when the market is noisy and unpredictable: position size when trading. Chapter 3. Reduce your trade size. In a volatile market, trading small doesn't mean you're afraid. It means you're smart. Did you know that one of the most common mistakes traders make, especially when the market is as volatile as it is now, is to continue trading with large positions as usual? But the market is like a roller coaster. Up 5%, down 7%, then a fake breakout, then a retrace, then FOMO news, then FUD news. Total chaos. And if you're still entering with 100% of your capital like when the market is calm, well, get ready to be the next victim. Trading small isn't weak. It's a survival strategy. In an unpredictable market, the goal isn't to make big profits. The goal is to stay alive. What matters isn't how much you can profit, but how long you can survive. And in conditions like this, the key is one thing: capital preservation. What is capital preservation? It's a fancy term that means don't let your capital drain away just because you're stubborn or overconfident. Remember this well. I'll give you a simple formula. If you have $1,000 and lose 50%, you're left with $500. But you need a 100% gain to get back to $1,000. Yeah, it's like climbing out of a deep ravine. That's why preserving capital is far more important than just chasing profits. Why does market instability make large positions dangerous? Because no one can predict short-term movements when the macro situation is chaotic. News can break at any time. War, inflation, economic data, central bank policies, FUD from Twitter, hackers, exploits, all of it can explode like fireworks. And even the most beautiful chart can crumble in minutes. Example: you see a bullish setup. You go all in because you're confident. Then, a few hours later, breaking news: Binance is under investigation again. The market turns red instantly, and you're trapped. If you went in small, the loss is still manageable. If you went all in, you might end up being the next red candle. Tips to reduce size without losing potential. 1. Divide your capital into many small portions. For example, if you usually trade 100%, try trading a maximum of 20% first. 2. Use a tight stop loss. In a market like this, you can't expect prices to rebound after a significant drop. So a small cut loss is better than a large floating loss. 3. Set realistic profit targets. Don't expect a 50% ROI in a week. 5 to 10% is already great in such conditions. 4. Avoid high leverage. It's even better not to use leverage at all. If you must, don't exceed 2x, 3x. 5. Focus on the spot market if you're not yet a pro. Futures are a double-edged sword. They can cut meat, but they can also cut your fingers. And in a volatile market, that sword becomes even sharper. There's also a psychological aspect to it. Do you know why many people fail at trading in a chaotic market? Because they're already tense. Going all in equals heart racing. Seeing a red candle equals panic. Seeing a green candle equals FOMO again. In the end, equals emotional decisions. With a small position size, you're calmer. You can think more clearly. And you can sleep without worrying: I have to wake up at 3 a.m. to check the charts. The mindset should be like this: in a stable market, I can trade aggressively. But now, I'm a patient samurai. I wait for the moment that's truly clean. Because being a trader is like being a sniper, not a machine gunner. You have to know when to shoot and when to hide. So, the conclusion: market unstable? Too much noise. Too much confusing news. Reduce your position size. Don't be ashamed. Don't be prideful. What's important is that you can stay alive, keep trading, keep learning, and keep your capital for when the market becomes clear again. If you can survive uncertain times, you'll become a much stronger trader in the future. Remember, it's not about how much you win today. It's about how long you can stay in the game. That's it, bro and sis. Chapter 3 is now complete. Hopefully, your mindset is stronger and you're calmer when trading. Let's move on to the final chapter. Ready? Chapter 4. When in doubt, stay out. Not entering the market is also a position. Let's start with an important fact that often makes many people scratch their heads. If I don't make any entries, does that mean I'm not productive as a trader? That's completely wrong. Sometimes, the most productive step you can take in trading is doing nothing. Yes, you heard that right. Not every day is a day to enter the market. Not every moment needs a response. And not every candle needs to be analyzed like a sacred text. Why? Because trading is about probability. And if you're still unsure about the probability of your trade, why force it? No position equals full control. When you don't hold any positions, you're in the most neutral state. You can think more clearly, without emotional baggage, and observe the market without bias. Compare this. 1. You already have a position, then see the market start to drop, you start to panic, overanalyze, and eventually make an emotional decision. 2. You don't have a position, see the market drop, you can analyze calmly, find strong support levels, and wait for a bounce. No pressure, no FOMO, no screaming in your head. Market chaos equals time for natural selection. Under normal conditions, you might trade 3 to 5 times a week. But when the market is like this, full of uncertainty, war, inflation, and escalating global politics, it's not the time to be active. It's time to be selective. If you're unsure, don't enter. Wait until you're certain. This is a simple yet powerful principle. And what's tragic is, many traders know this, but never truly follow it. Why? Because they're afraid of missing out. Afraid of not making money. Afraid of being seen as doing nothing by their peers. Yet, in reality, traders who often sit tight and wait for clear opportunities typically have a higher win rate than those who open positions daily like playing a guessing game. If in doubt, stay put. It's not just about technicals, but also psychology. For example, if you're lacking sleep, just had an argument with your partner, mentally exhausted, overthinking because of a previous losing position. All these are signs that you're not in an ideal state for trading. And when you trade with a shaky mindset, the unpredictable market becomes even more ruthless. Here's the wisdom. Don't just look at the chart. Also assess your mental state. If you're unsure about your analysis or unsure about yourself, stay out. Trading is a marathon, not a sprint. And you need energy, focus, and stability to survive in the long run. Tips to avoid entering the market when you're uncertain. 1. Have a clear watch list. If an asset isn't on your watch list, don't look at it. 2. Use a trading journal. Write down why you didn't enter. This is important for future lessons. 3. Determine ideal conditions before entering. For example, I'll only enter if BTC retests support and volume increases. If those conditions aren't met, just stay out. 4. Channel your energy into productive activities. Study old charts, read on-chain data, or refine your strategy. 5. Remember, cash is position. Sitting on the sidelines with cash is like stalking your prey from afar. Be patient, your time will come. So, the conclusion is this. When the market is uncertain, it doesn't mean you have to always be in the market. Sometimes, the best choice is to wait. Not because you're afraid, but because you understand that not all opportunities are worth it. Not all setups are worth taking. And not all candles need to be traded. When you can start saying, no, I'm not entering today because I'm not sure, it means you've leveled up as a trader. You're no longer controlled by emotions, but by your system and self-awareness. Remember, bro and sis, the market is always there, but your capital isn't. So use the quiet times not as a weakness, but as a strategic strength. Ready, bro and sis? Now we've reached the final part. This isn't just a conclusion, but the perfect time to bring together all the lessons from this episode and give you a boost of motivation to stay sane, focused, and strategic in facing this roller coaster of a market. Let's go. Closing. In the midst of a volatile market, don't forget who you are. So here's the thing, bro and sis. In this episode, we've had a casual but deep conversation about one important topic: how to trade in uncertain situations. And if you've made it this far, it means you're not just any viewer or listener. You're serious. You care. You're not just looking for quick profits, but you want to stay in it for the long haul. That alone sets you apart from 90% of other traders. Let's recap the key lessons. 1. Focus on Bitcoin. In the midst of confusion, don't add to the noise. Hold on to what's strongest, clearest, and has the most solid foundation, Bitcoin. 2. Only trade high conviction plays. Don't jump in just because there's a pattern. Enter only when you're confident. And that confidence isn't driven by FOMO, but by strong reasons. 3. Reduce position size when the market is unclear. This isn't about being cowardly. It's about being smart. Your money is more useful when used at the right time. 4. When in doubt, stay out. Not entering the market is also a position. Staying quiet doesn't mean you're weak. Sometimes it's proof that you've become a more mature trader. And if you're feeling down, confused, or unsure, remember one thing. Our main goal in crypto isn't to win every time, but to survive long enough to win big at the right time. Because in a market like this, the strong aren't the ones who trade the most, but the ones who know when to act and when to stay put. And you, bro and sis, you who are listening to this now, you're already one step ahead because you're learning, reflecting, and ready to act consciously. Before we say goodbye, remember the 5 important rules from Mr. Suw Crypto. 1. Don't use hot money. Money that keeps you up at night isn't capital, it's a burden. 2. Don't over-leverage. You want to get rich, not go bankrupt in a flash. 3. 70% Bitcoin and 30% altcoin. This isn't dogma, it's an asset protection strategy. 4. Always keep cash on hand to buy the dip. This doesn't mean holding cash indefinitely, but being ready to seize opportunities when big discounts come along. 5. Think long-term. Even if you're scalping, your mindset must remain resilient, because those who endure the longest reap the biggest rewards. Final words from Chatty and the Mr. Suw Crypto team. If you gained insights from this podcast, help us grow. Click the subscribe button. Give it a like so the algorithm doesn't get confused. And share this podcast with your friends who are also feeling overwhelmed in this noisy market. If there's something you'd like to discuss with us in the next episode, just write it in the comments section or DM us directly. The market may be chaotic, but our mindset shouldn't waver. See you in the next episode, and don't forget, DYOR. I'll sign off for now. See you in the next episode, and stay smart in this unforgiving market.